I think we're just going to go ahead and just do a really quick refresher on what we talked about last week. So we'll go ahead and get that going whenever you're ready, Dan.
Last week, we talked about the call debit spread. And very specifically, I said last week that this week I'll explain why the call debit spread has a lower volatility and less Vega impact. But just as a quick refresher, a call debit spread occurs when you buy a call that is close-ish or in the money, right? You buy a call and you sell a further out of the money call. And that structure is locked in stone. For a call debit spread, it has to be selling a further out of the money call. If you reverse those, you get something called a call credit spread, and that's definitely not the same thing. So the call debit spread is bullish, just like buying a call outright. And the P&L graph of the call debit spread, once you get to expiration, has this kind of like it's very binary compared to buying a call outright, because buying a call outright has a theoretically unlimited profit, whereas call debit spread is going to have a capped profit. Once the price of the underlying goes above your short leg, you're in that max profit zone. And so a call debit spread is like a very much a binary bet. I've heard it referred to in the past as model free. Like you don't need a model to predict the value of this spread as time goes on. It's like it's very clear. Once you're above that short leg, you're going to reach the max profit minus transaction fees and commission paid to your broker. Below the long leg, just like an outright call, you're looking at a max loss, and the max loss is the debit paid for the position. Just a last thing here, a reminder that the call debit spread, when it starts off as like kind of curvy here. It still has very well defined big max profit zone and max loss zone, but it doesn't get to that very sharp edge call debit spread profile until expiration. And so last week I said one of the pros is that a call debit spread has lower volatility with respect to price. It also has lower volatility with respect to implied volatility, and we'll talk about that as well. And that's what today's presentation is going to be out. There's less Vega impact, which is directly related to implied volatility and how implied volatility can change the value of an option contract. Let's go through part 2, volatility specific concerns with a call debit spread. Like I mentioned in my little recap, today I want to talk about the lower volatility with respect to both price and actual implied volatility Vega impact on this structure, because that's what I said I would do last week. So you'll recall last week we were considering a JPM call debit spread where the trader, our theoretical trader, is going to buy the 205 call and sell the 210 call. And when creating this call debit spread, what I want to do in this little section right here is compare the call debit spread to buying a call outright. First and foremost, there's obviously going to be a price difference. Buying a call debit spread has to be less expensive than just buying the long leg, because you're selling a further out of the money option and you collect that as a credit. And so your net price winds up being the long leg minus the short leg. And like we talked about last week, the Greeks on a call debit spread are similar to the Greeks on an outright call, but they are a little bit they're a little bit muted by comparison. You're going to get more delta if you buy an outright call, because there's no short leg that's subtracting deltas from the structure. The same goes for Vega, which is what is influenced by or is what is tied to implied volatility. because you'll recall that Vega is a value associated with contract, and for every one implied volatility point up or down, the Vega value of your contract is going to be the change in price of your contract with everything else left as is. So if you buy an outright call here, like on JPM, initially, when we opened this outright call, we had a Vega of 0.10 here, and Vega is this pink looking one here at the very bottom with a Vega value of 0.10. If implied volatility increases by one implied volatility point, so right here it looks like it was around like 28. If implied volatility went up from 28 to 29, the value of this contract would go up by 10. So it would go up by like $10, 10 cents. Your account would go up by $10 because options are equity options get multiplied by 100. And the discussion of implied volatility is actually kind of valuable, and I did this on purpose because it kind of lends itself really well to this discussion that we're having right here. You'll notice, so what I have in this kind of dark blue clip is the spot price of JPM. And then in this purple clip, I have the implied volatility of the 205 call. If you bought the 205 call here somewhere while JPM was trading at like, I don't know, maybe like 197.5 or 198, and you had this Vega value of 0.10, even though your Vega value was increasing from 0.10 to 0.12, it didn't really increase all that much. And the implied volatility during this day, during Tuesday, August 6th, was actually going down. So because implied volatility was going down, this positive Vega was actually working against your contract. Now, you didn't lose money on this trade, right? Like during the day, your contract maybe traded up from $1.50 to $2.25, something like that. These blue vertical lines are where the day, where we roll over from one day into the next. And so you could see it was great. You made money on your option, like you made a good delta trade. The underlying price went up. You bought the call. Your deltas were increasing, which is great. Thank you, Gamma, for that. And the spot price of the underlying was increasing as well. And so the value of your option had some nice appreciation during the day, right? It went up from like $1.50, and let's say maybe it closed around like $2 or $2.15, somewhere right around in this area. And we know, like, we can just visually look at this thing right here, that almost all, if not all, of that profit came from delta. Because when we look at the implied volatility and we look at Vega, even though Vega was increasing, implied volatility was going down, right? And so the fact that those two are moving against one another tells me that the P&L of this trade associated with implied volatility and Vega was small, if not zero. And the reason that that's important is, I think, best demonstrated by like thinking about earnings. Everybody, it's like a rite of passage. If you are trading some options and you buy a call or you buy a put before a binary event, and the implied volatility collapses after that binary event, the value of that option can go down very, very fast, and that can be very unpleasant, especially when you're directionally correct with your trade idea, right? And so when you're trading calls and puts directionally, if you do not have a strong view on implied volatility, sometimes you can get kind of burned by this decreasing implied volatility. And then especially as time goes on, right? You can see this last bar right here was the transition from Friday until Monday, and you can see even though implied volatility came back up because we're implied volatility is rising because we're nearing the expiration of this monthly August $205 call for JPM. We can see our Vega value came down quite a bit. It dropped from like let's say 0.11 to almost 0.8. That's a pretty big decline. That can definitely negatively impact our contract value as time marches on. And so in terms of price volatility, which I'll speak to next, in terms of like a call debit spread Vega versus an outright call Vega, the Vega value of the call debit spread is going to be really, really small by comparison, because you're buying that long call, but you're selling a further out of the money call, and you're winding up with a net of those two, which is subtraction. And what's kind of interesting is that the net Vega on this call debit spread as time has gone on has gone down, but it started off really low anyway. So there just wasn't a lot of implied volatility impacting your option price in the first place, right? It's very easy to see, hey, this Vega dropped by more than half. What gives? Well, it was already really low in the first place, so any minute implied volatility impact you might have experienced on your call debit spread is approaching zero, and it's becoming more and more of like a binary kind of over under bet on the price of JPM. And so to wrap it up here, we can see if we took this outright call trade and we entered somewhere around like $1.50, then at the end of Monday we had a great trade, right? It's up at $3, and the range of that trade though has been pretty significant, right? We saw it more than double, like overnight from Tuesday into Wednesday, and then we saw it come all the way back down, almost around our entry area, somewhere here around $1.50. Maybe it came down to $1.75, but it's been moving up and down quite a bit since then, and that price volatility can cause management headaches, right? Because you need to manage this trade. You got to decide whether or not you think you're at a profitable place to take the trade off, or if you want to keep sort of letting it ride and hoping to experience more of that infinite upside. Now, if you look at the shape of the call debit spread, like compared to the outright call, you'll notice that they're pretty similar, right? It's like kind of sloping from the bottom left to the upper right, bottom left to upper right. There's like some up and down during the week, especially on Wednesday, right? The value of this, if we filled this trade here somewhere around like 85 cents, which is what I was talking about in the last presentation, we saw it go all the way up almost to $2.25, which is great. That's almost a 3x. And then it came all the way back down to just be maybe up by like 50% or so. And since then it's been kind of moving up, but not without some associated volatility. And where this trade becomes a little bit easier to manage is in just observing the overall ranges of the prices are just smaller, because there's a short call on the other side of that long call, and the short call is always kind of moving in scale, in tandem with the long call. And I say that with a caveat because as you get closer to expiration, if if the long call is in the money and the short call is out of the money, then you'll notice some really interesting and potentially valuable effects because the out of the money call will be decaying really rapidly, whereas the in the money call is also decaying, but is decaying. They're both decaying towards their intrinsic value, and the in the money call actually has intrinsic value, whereas the out of the money call does not. So it's decaying towards zero, while the in the money call, the long call, is decaying towards whatever its intrinsic value is. Maybe $1 if JPM is at 206, or $2 if it's at 207, and so you can get some interesting effects at that time as well. But the long story short on the price range of a debit spread versus the outright call is that it's just going to be smaller, right? Like this outright 205 traded from like $2 to $3.50, right? And this one and this call debit spread traded from maybe $1.60 to $2.50, and that's like 75 cents or 80 cents of less price volatility. And so this reduced price volatility can be a pro or a con, right? If you have a view on implied volatility and you think implied volatility is going to keep rising, then you would not want a call debit spread, because the call debit spread is going to mute that implied volatility, and it's going to mute some of the delta impacts of the long leg of the call. But if you don't have a strong view on implied volatility, and your assessment of the scenario tells you that it might lend itself well to a kind of like a binary over under kind of bet, then a call debit spread is going to be really beneficial. It's going to be less volatile, and you're not going to have to manage it as tightly as you might manage an outright call where you're trying to express the same idea. To put a finer point on it, if you're thinking about a call, especially if you're thinking about an out of the money call for like a shorter term, to express a shorter term trade idea, and especially if you do not have a view on implied volatility, if you're not sure, you don't think you don't know, or you don't have a prediction or something like that, then it's probably worth considering a call debit spread as compared to an outright call, because this call debit spread has some conveniences just sort of built in that are natural to the structure, and that might make it a really good way to express your view. Not to mention that they're like less expensive too, especially in liquid options. Maybe you can buy a few, like if you can buy 2 call debit spreads instead of buying 1 outright call, I know that you're starting to rack up more transaction fees, commissions, exchange fees, what have you. But there's something to be said for buying 2 call debit spreads and having your trade idea work out, and selling 1 call debit spread at like plus 105 or 110%, because then you can sell half of the position, and now the other half is risk free. So you really can say, hey, I'm not going to overthink this, right? I got all my initial capital back. I'm no worse off now than I was, a few days ago, or whenever you put the position on, and you can really just let it go, instead of potentially managing it too early, or letting some other stuff kind of like cloud your initial view. And that's not to say you shouldn't update your view if things change. I mean, absolutely, change your mind, change your position if the reasons for putting a position on have changed. But I think it's really easy to, depending on your style, to like kind of overthink it, and to take something down before your idea might fully play might fully play out, and something like a call debit spread can work in your favor in that regard. It can like protect you from yourself in a way. And so that's all I got. That's all I got prepared for this one, right? Really, all I wanted to do was just like close the loop on this, like the Vega impact, right, and show that on a real position, real time has gone past, right? How Vega started off low, right? It was started off at 0.04 compared to the outright call, where the Vega started at like 0.1. So your Vega, you have less than half of the Vega of the outright call, and it went down, and it just sort of stayed low compared to the Vega of the outright call, which moved its way above 0.12 and now has come all the way back down to like, maybe 0.085. So, the volatility differences both in price and in implied volatility impact are what I wanted to hammer home today.